Hi, my name is Scott O'Neill. We want to thank you for purchasing this Level 2 Home Study Kit. It should be a great addition to your investment library. I, along with some of my colleagues, will take you through this course. Our starting point will be to review the psychological aspects of the stock market. As you are probably aware, the stock market has many emotional components to it. We believe investors have to look at the stock market a certain way if they're going to be successful year after year. So let's open the workbook and start with Section 1, the Foundations for Investing. Number 1. Bernard Baruch, an accomplished investor, once said, "The stock market is human nature on parade." What he's referring to is that we're all human, we all have emotions. The problem is that those emotions in many cases will betray us at critical points in the stock market. So we have to figure out a way to separate our emotions from the investment decision-making process. A good way to do this is to do a post-analysis on your trades. Take out a chart, plot your buys, plot your adds, plot your sells, and look at what you're doing. And you'll see in many cases when you lose money, you'll see that you are swaying from the rules. The emotions took over. Now there's one other reality. If we're going to be successful year in and year out in the stock market that we have to accept, and that is that the stock market is bent on fooling the masses. Number 2, what works in the market is contrary. It's contrary to the way normal, intelligent people think. It's 180 degrees the opposite way. That's why most people have trouble with the stock market. We must operate on rules. Rules in order to compensate for the market's cunning behavior. Most investors do not operate on rules. They don't realize that you must operate on rules. Number 3, the market operates on 2 basic emotions, fear and greed. Now I know everyone has heard that many times. We believe that you can never hear that too often because in the heat of the battle, when you're feeling pressured, that's when the mistakes occur. You can veer and make a quick mistake that will be costly. The market operates on fear and greed. The problem is most investors mix the two up. For instance, let's say a stock is down. The typical investor is going to hope that that stock will go back up. They can possibly sell it and break even. Well, they really should be fearing that that stock will go down further. Why? Because, as we know, stocks trend. They tend to trend. So the probability of that trend is to go down further. You see, it's all psychology. It's all human emotion. We must control our emotion. Here's a good little example of what we're talking about. Ego comes down to hope, fear, greed, and pride, and then you can look, hope. They don't cut their losses when they should. You know, there's an old saying, the first loss is the smallest loss, and some average down. Pride, because I'm prideful, I'm not going to cut my losses. Number 4, the best way to take emotion out of the investing equation is to have a proven system. System with sound rules to follow. When you're scared, when the screen is totally red, when you open up IBD and you see all the stocks you're following are underlined, your drawdown in your account is really starting to bother you, you can't go on how you feel. You've got to have rules to help you navigate. When you're not sure, turn it over to the rules. Now the same is when you're up big. Let's say the screen is totally green. Stocks are bold-faced. Your equity is soaring. You need rules to keep you grounded. It's too easy at that point in time to start getting sloppy or greedy. You know the old saying, bulls and bears make money, but pigs get slaughtered? Number 5, the CanSlim investment system is based on fact, not opinion. None of Can Slim is our opinion, unlike a lot of Wall Street's research. We simply observed the market itself and we documented our observations. What we did was we looked at the greatest winning stocks from 1950 to today, and we built models of them. And we looked at what were the common characteristics of all of these great winners just before they exploded and had their big move, and what did they look like, what were the common characteristics when they all topped. And from all of this research, we developed our rules. Our buy rules and sell rules are based on the reality of the marketplace. So really, they're not our rules. They're the market's rules. Here's an example from this research. We found that when a great winner tops, because they all top at some point, they will drop on average 72% from the peak to the trough. Most people don't know that. Wall Street doesn't seem to talk about a statistic like that. What advice do you get from friends or Wall Street? Let's buy on the dip. All the while, you're buying on the down slope. See, we have rules that will get you out near the top, that will keep you out of the market when you should be out, and will get you in when you should be in. Let's look at a couple charts real quick. Here's Yahoo back in January of 2000. And here are some of the comments that were out there at the time. One analyst says, over the near term, don't sell positions, stay the course, look for dips. There it is. January 12, 2000, 3 firms raised price targets, one adding, it's not prudent to chase Yahoo at these levels, but rather to buy on dips. Where did it end up? Well, up at the top here, it's at 250, and it went down 97% in 20 months. This is that drop on the back slope. Let's look at one more. Qualcomm. What a great stock that was in its day. December 29, 1999. Analyst raises price target to 1,000. That's an equivalent of 250 after the split. Where did it end up? Down 88% in 31 months. See, rules versus emotions is a critical piece in this game. Rules, discipline versus emotions. That's what it comes down to. We've got to separate those emotions. We can't stress that enough. Number 6, mistakes made in the market are really just tuition. Tuition payments to the School of Wall Street. I know it sounds kind of funny, but we all make mistakes. You're going to make mistakes at this. I make plenty of mistakes. Bill O'Neill will tell you in a second he makes plenty of mistakes. That's actually not the issue. The issue is how long does it take you to recognize those mistakes and how quick are you to fix them? Then obviously you don't repeat them and you move on. So you incrementally, year over year, get better and better. The reason most investors lose money or achieve mediocre results long term is that they make too many mistakes. It's the mistakes that undermine us. We believe it takes 2 to 3 years for the typical investor to make all of the classic mistakes. For instance, buying extended, buying too much. Your group concentration is wrong. Decisions made on emotion. Holding losing stocks. Now there's an interesting one. I don't know how often I have heard it's a good company and I'm just going to hold on to it while it's tanking. Buying when not in a base. Moving too much money into the market too fast. Buying cheap stocks. I don't know why some people are so enamored with buying dollar stocks. Statistically, it's proven that when you're down there below the teens, you have a lower probability of success. Plus, major mutual funds And hedge funds typically can't get a sizable position down in that area, so they avoid it altogether. It's a long list of mistakes, and everyone has to go through it firsthand. But once through it, we believe that your results will improve dramatically. You see, you have to be able to recognize and not repeat these mistakes, and that is much easier said than done. Why? Because those mistakes are our human nature. See, back to number 1. So the best way to uproot these kinds of mistakes, to put them to rest, is to analyze our trades. Again, do a post-analysis so you can look at what you're doing in the market. We believe that this analysis, the payback on it is tenfold of what you put in and what you get out of it. The stock market is a skill thing, like tennis, writing, the piano.